Business and finance may initially seem overwhelming because of the complex language used. But once you understand the core terms, you begin to see that business is simply about how value is created, money is managed, and decisions are made under conditions of uncertainty. Let us start with revenue, which is the total income a business earns from selling its products or services before any costs are deducted, and it represents the top line of a company's financial performance. While expenses include all the costs required to run the business, such as salaries, rent, utilities, marketing, and raw materials. When expenses are subtracted from revenue, what remains is profit, which is often considered the true indicator of a company's success and sustainability. However, profit alone does not tell the full story, which is why cash flow is one of the most important concepts in finance, as it measures the actual movement of cash in and out of a business, reminding us that a company can appear profitable on paper but still fail if it cannot pay its bills on time. Moving further, assets are anything a business owns that has economic value, including cash, inventory, equipment, property, and even intangible items like brand value and intellectual property, while liabilities represent what the business owes, such as loans, taxes, and unpaid supplier bills. And the difference between assets and liabilities is known as equity, which reflects the owner's or shareholder's stake in the company. Another key term is valuation, which estimates how much a business is worth based on its earnings, growth potential, industry position, and market conditions. And valuation becomes especially important when companies seek investment, mergers, or acquisitions. To fund growth, businesses often choose between equity financing, which involves selling ownership shares, and debt financing, which involves borrowing money that must be repaid with interest. Each option carrying different risks, costs, and levels of control. In the stock market, a share or stock represents partial ownership in a company, and investors earn returns through capital gains, which occur when the stock price increases, and dividends, which are portions of profit distributed to shareholders. Understanding market capitalization, or market cap, helps investors classify companies as small, mid, or large cap and assess their stability and growth potential. While liquidity refers to how easily an asset can be converted into cash without losing value, an essential consideration during times of uncertainty, risk is unavoidable in business and investing, which is why concepts such as risk management and diversification are critical, as spreading investments across different assets helps reduce the impact of losses. Finally, return on investment, or ROI, measures how effectively money is being used to generate profit, helping businesses and individuals compare opportunities and make informed decisions, reinforcing Warren Buffett's famous insight that risk comes from not knowing what you're doing. Once these foundational terms are understood, business and finance stop feeling intimidating and instead become practical tools that empower individuals to analyze companies, evaluate opportunities, and make smarter financial decisions in an increasingly complex economic world.